Good morning to you both. David, I'll start with you. And we were just parsing through some of those key stats within this morning's report. The fact that we have the Dow down almost 500 points right now and the S&P down more than 2%. What's priced into the market here? Because we've had a lot of debates about whether this tighter, more aggressive Fed rate of hikes through the end of the year was actually priced in. And looking at today, maybe not.
Well, no, I think it is priced in. I mean, if you look at the futures market, it hasn't really moved since the September meeting. What the markets are pricing in is actually what the Federal Reserve is saying, which is 75 basis points in November, 50 basis points in December, probably 25 basis points in January. That's what's priced in. That's actually the same. It moves marginally. But I do think the market's misreading this. I agree completely with Steve on this. You know, yes, inflation is coming down. It may be coming down more slowly than the Fed wants. But I would point out that 5% year-over-year growth in wages, that's the lowest since we've seen since last December. And what's more, the CPI inflation rate, we think in September will be about 8%. So we've got 5% growth in wages, 8% growth in consumer prices. So are wages adding to inflation or actually subtracting from inflation? Now, I would argue that with wages running below the inflation rate, they're actually pulling the inflation rate down slowly. So I think everybody needs to be a little bit patient here. This is not a traditional labor market. You know, given the weakness that we're seeing in GDP in the first half of the year, you'd think we'd get negative payroll jobs. We don't because of pent-up demand. And given the amount of, 10 million job openings, actually you'd expect to see stronger wage growth than we're seeing, but we're not seeing that either. So I think this is a new world in terms of the labor market, and the Federal Reserve should be a little bit more patient in interpreting this as somehow inflationary, because I don't really think it is.
Darrell, I want to get your thoughts on this, and specifically to the question I just asked David. What do you think is priced into the market here?
So I think David's right. I think aggressive tightening, 75 in November, 50 in December, 25 in February is probably the most likely path. I think the most important number of the morning was that 5% average hourly earnings number. It's just not, it's too hot to bring down core CPI. And I think the surprise, probably leading Morgan into next week, and you hit on it, following up on Steve's comments about your intelligent comments here, is that if you simply take the consensus, which is a 0.4 increase in core inflation next week when we get the CPI number, that takes core CPI from last month at 6.3 up to 6.5% with the baseline math effect. So I don't think the market is going to like the fact that core inflation ticks higher by 1/10 or 2/10 next month, or excuse me, for last month, next week when we get that data. And I think it probably leads to another leg lower in asset prices.
So, David, where does an investor put their money to work right now? Is cash king, or if we have the Fed's most likely trajectory already priced into the market here, are there opportunities to be had?
Not at all. For a long-term investor, well, first of all, there's lots of opportunities. And for a long-term investor, I would say cash is definitely not king right now. Prices are much, much better than they were, obviously, at the start of the year. There's a lot of available opportunity, both in U.S. equities. I mean, I still think that in a valuation perspective, value equities in the U.S. are better than growth equities, a little bit better. But they both look pretty good here. And I would point out, the dollar at a 40-year high in real terms, it makes international equities look extraordinarily cheap. Now, I know that I have been saying that, and you can say that for a long time, but I would not want to be short international equities in this environment, because if the Fed pivots at some stage, or if there's some settlement in Ukraine, those international equities are going to take off and the dollar is going to come down. I really want a piece of that. So I think there are a lot of opportunities to put money to work in this market today.
Shepard Smith here. Thanks for watching CNBC on YouTube.